All right, let's get the session started. I know everyone's really excited to hear maybe about finance a little bit more. I know we had a session earlier this morning, but happy to dive a little bit deeper into what we're focusing on in finance and banking, overall in investment management. I know in this conference we heard a lot about space, biointelligence, different applications of AI, as well. So happy to dive a little bit deeper into finance. To get started, my name is Angel. I am most recently a senior engineering leader here at Stripe, covering AI ML applications for financial payments. Previously spent some time at Facebook, as well as JP Morgan. I'm based in New York, but here in Singapore this week for this conference. So excited to meet everyone and to moderate this panel. We have an awesome slate of panelists on the panel. So I'll have each of them give a brief overview about themselves and their background and kind of their expertise as it relates to kind of finance and AI on our panel. Off to you, Charles.
Thanks, Angel. Super excited to be here. Thanks for having me. So Charles Dong, co-founder at Arta Finance. I started my career actually as an investor, private equity at Blackstone, and venture, long-short hedge funds. And then I saw the light, moved to tech, met my co-founders at Google actually, where we led product for Google Pay and Google Finance, really working on how people move and manage money at scale. And the idea for Arta came from a problem that we ran into in our own lives, where spreadsheets, robo-advisors, retail brokerage accounts just weren't cutting it anymore. And then one of my co-founders graduated into this magical world of private banking, right? And immediately got access to private equity, structured products, world-class expertise, but only after meeting that $25 million asset bar. And so we started Arta to really digitize and democratize private banking to the rest of us. And we're using AI at its core to make that smarter, more accessible, more scalable.
Sambit?
Hi, I'm Sambit Sahu. I'm Vice President of AI Research at AI Foundations at Capital One. My group focus actually is LLM customization and agentic AI, where actually we are building and innovating how to solve all these financial problems, business problems in Capital One using LLMs. Before that, I was in Alexa, where I focused on actually building the large language models for Alexa. And prior to that, I was in IBM Research for a long time. And also, I am in the adjunct faculty at Columbia University, where I teach a course in this area. I live in New York, and yeah, that's about myself.
Hi, my name is Sigrid. I work for EFG Bank. If you wonder, it means European Financial Group, not just ABCDEFG. I've been working in the world of data AI my whole career. I studied statistics. I've been working in research in the beginning and then transitioned into FMCG before moving to finance. So at EFG, we are in the middle of a transformation. So EFG is a Swiss private bank based out of Switzerland, but with a big presence in Europe, Asia, Middle East, and the Americas as well. And so we are currently in a digital transformation, and AI and data is obviously at the heart of this transformation. And I'm based in Singapore. I've been here for 16 years, originally from Europe as well.
Awesome. As we think about finance more broadly, I think from my experience in investment banking, asset management, even investment management, a lot of it comes from either deals from your networks, precedent, relationship-based banking. So I'm curious, in the age of kind of generative AI, LLMs, we can obviously leverage this tool to unlock maybe opportunities that previously we don't know about or haven't discovered yet. And so what do you guys think is kind of the primary value add here as we think about LLMs and how it can help us discover or unlock new opportunities, especially in this kind of ever-changing financial landscape? And I know a lot of times in this conference, we talk about agentic AI, and so I'm curious what you guys think are kind of the primary value add here in terms of applications specifically related to finance, investment management, and so on and so forth.
All right. So if you look at last 5 years, the AI ML space actually has completely changed. So we are talking about deep learning network with millions of parameter models. Now we're talking about billions of parameter models. So these models actually have unlocked the potential to do a lot of things. Even in last 1 year, the LLMs actually have progressed from solving, understanding to very complex tasks, moving from simple tasks to more agentic approach. So at least there are three areas where I see things going. So one actually is unlocking new values using this complex models, having the ability to reason, going through huge amount of data, huge amount of things in a matter of seconds. The understanding is mimicking pretty much the super intelligence, unlocking new values, alphas. Second, actually doing the same thing, what we're doing, but doing it much more efficiently. Because of the way all these financial investment bankings work, they deal with huge amount of data, text data, images, and audios, and also visuals. So processing this in a very small amount of time, very efficiently, having that ability to mimic human reasoning, this model's able to do a lot. So doing it more efficiently, the same thing. So cost reduction and doing it more accurately also sometimes. The third thing actually is making it assist. So for example, you may not have to solve all the problems, but you help the humans with assist, like developer assist, like all this code assist, or summarizing some documents and getting the 80% of the things done. So the three areas where I see that a lot of values have been being created. So we see that a variety of applications actually emerging in this space.
So in the banking sector, we are heavily regulated. We deal with a lot of regulation overhead. EFG is based out of Switzerland, so we have to abide to Swiss regulation, we have to abide to EU regulation, to all the regulation across the world where we operate. So an obvious use case for us is everything related to compliance, and there is really a lot of overhead and a lot of processes related to doing checks on KYC, where your customer comes from, source of wealth, making sure that the money that they're bringing to your bank is clean. So on top of this, the clients that we serve are high net worth. So they live in Singapore, they have businesses in Hong Kong, they're sending kids in the UK. So all these cross-border rules adds up as well, a level of complexity. And so a lot of compliance tasks, and those tasks are not limited to the compliance function. The front office staff also have to help in all these processes. So it's a very obvious use case is to use Gen AI and agentic in general to streamline all these processes. There are some scary statistics saying that relationship managers spend 70% of their time doing non-advisory tasks, which should be, honestly, all these should be completely automated and streamlined. So it's a very obvious use case. And being the AI officer in a bank, we obviously serve front to back, so we also work closely with the front office people, as well on the product side. So on the products, which is more related to the investment side, obviously they use it for streamline research, summarizing, translating, do their product due diligence. So anything that has a lot of documentation and summarization required, that's where we can serve. And everyone can actually benefit to the platform that we are using, from HR, marketing to the front line.
Very interesting. And we see that as well, as we partner actually with a lot of banks and family offices to provide technology to them and power their businesses as they see us use it for our own regulated wealth management business for high net worth clients. And those are the classic use cases, right? Operations, compliance, front office, advisory enablement, tripling the effectiveness of the time that an advisor can spend with their clients from, call it 50 to 100 clients per advisor to 150, 200, 300. But even if we can triple the effectiveness of advisors, right? If everything is still gated on a human advisor, that means that high net worths being served at private banks go from 0.0003% of the population to 0.0009%. And as my Asian tiger parents would say, not good enough. So what we're trying to do is push the ball forward in addition to all these sort of internal use cases for internal productivity, which absolutely make AI more accessible, more scalable to many more people, but also with direct-to-client-facing experiences. So we have a suite of AI agents that's purpose-built for wealth with the right guardrails. Anything near your money has to be right, has to be transparent, has to be explainable. But as an example, we have a feature called Research Analyst. And it mimics what I did as an investment analyst at a hedge fund, right? I would go off for 3 weeks. I would do deep, detailed diligence across SEC filings. I would do borrow factor analysis. I would do the benchmarks, build the model, all that kind of stuff. Now that can be done with a suite of 20 agents with the right quantitative investment tools and the right guardrails in minutes. And so everyone can walk around with a research analyst in their pocket and instead of going to their advisor and getting a report back from their bank's research team in days or weeks, now you can get it in minutes and riff on that. But of course, you want human oversight before any trades are actually made. So.
Yeah, I think that makes a lot of sense. A lot of times we have these kind of outputs, decisions outputted by these models, but sometimes we need to have like a human in the loop to validate, to make sure that whatever is being outputted is accurate and that we can use it given the right safeguards. I think to that end, in this panel and throughout the rest of this conference, we've talked a lot about how great AI is more generally, how it can augment really people's lives and our interactions with the world from a day-to-day perspective. However, we've also noticed more or less kind of a trade-off between performance as well as explainability or observability into what goes into the model. For example, a lot of times we submit an input, it goes through some of this black box modeling outputs, an output that we can use to make a decision or take an action. So I'm curious on this panel's perspective on kind of how we can think about redefining explainability, especially in the context of financial decision making, especially given this kind of oftentimes what we see as a trade-off between performance and transparency. How do we think about that trade-off, and how do we think about redefining explainability in this context?
So maybe I can take that. So trading off innovation versus some of the risks, basically. So banks are in the risk, tend to be risk averse, so in the risk dealing business. Establishing trust with the various stakeholders is very important. And so we take all the governance piece very seriously. So we have a strong AI governance in place. So the way we started is we had a bunch of people from around the company coming together because AI cannot be operated only in isolation and with a few data scientists. We really need the support of everybody. So it includes the risk team, obviously the compliance team to make sure we abide to regulation, the data protection office, legal, IT, info security. And so we all formed that group that eventually became a governance body within the bank that is being used for the big decisions on how we bring models in production, how we have any escalation path. So that's one of the foundation layer that we have. And then in this committee, we take a very systematic risk and control-based approach. So we look at the different risks associated with different use cases. Some use cases are less risky. So if I just run a IT ticket triage use case versus a credit risk scoring, obviously the risk associated with it is going to be different. And based on the risk level, then for each, we look at each of the risks, be it bias, fairness, explainability. We have a list of them. For each of them, we have a level associated with it. And based on that level, then we'll have different types of controls and mitigations measures that we put in place. So it's a very systematic approach, the easiest way to work around that. And finally, the last piece that we work a lot on is literacy, making sure everyone understands that when they bring a new AI tool, it cannot just be brought this way. We have a strict third-party risk management, meaning that when we want to bring in a new product that you guys are building, they also need to abide to the same principles and making sure that we safeguard our clients and the trust that we have established with our different stakeholders. So a systematic approach, which sometimes is a bit more on the compliance, the risk-averse side of things, but it's very important that we have the trust with our customers. So, and I've seen walking around, a lot of the companies are emphasizing on the tech part, which is very exciting, but you can't forget that aspect. That is why it makes our life a little bit difficult to actually incorporate some of those tools very quickly in the enterprise. Yeah.
Yeah, just to add, finance industry is very risk-averse, right? But just to be honest, genie is out of the box, right? Out of the bottle. So it's a lot of power, but with power comes responsibility, right? So at Capital One, actually, we pride ourselves as a very well-managed, meaning that we have to do good things, we have to adopt technology, but it has to be done the right way. So initially, what we are doing, besides what Sigrid mentioned, many of these applications actually is operating in the mode of like human is assist, like more kind of augmenting the capability. Human agent actually in the decision making. The machine in the back does all the groundwork, but finally it comes to the human being to actually approve or disapprove. So with that, actually, you gain confidence. So we go through this whole process to actually make sure, besides the guardrails, besides this thing, a lot of check and balance are done. Once actually you have a lot of confidence, then actually you slowly start actually trying to deploy this in phases to actually in real world. So it's also evolving in the sense that the AI regulations what was there earlier is being kind of contextualized. What does it mean here? Because LLMs has a lot of powers, but at the same time it has also a lot of tendency to hallucinate. The hallucination is not a bad thing, actually. It's actually innovation. So when you're thinking, you're also like trying to be innovative, right? So, but you have to make sure it is grounded, it is following all the policies, it's able to follow all the complex logics and regulatory policies. So making sure that is very important. So the good thing that is all these models, especially the models with reasoning capabilities, are able to actually address this very nice way. So if you use these models in the right way, when actually say, hey, explain that why you're doing this, they tend to actually adhere to the policy a lot. So there are some policy issues, there is some adoption issues, like and also regulatory issues. Also, there is also a lot of technical issues. So they're all combining together is where we are seeing things are progressing, and we're seeing some early very good success, very good results in this space. So,
just to add to what Sigrid said, I think the entire wealth management industry is built upon one thing, and that's trust, right? And so at the heart of it, it's governing the right risk-based approach and all of that. And actually, if we think about the issues and the hiring practices, company policies, compliance policies, and many of these risk controls aimed at human advisors as well, there's actually a lot of unobservable behavior that goes out and is presented to the client in a way that AI agents actually have a leg up on in certain cases, right? Where advisors will typically use an internal tool. It's a deterministic model to actually punch in the client's suitability, their risk, whether they should have 30% or 40% allocations. And that deterministic model is blessed by the bank, by the advisory firm, to give the right recommendation to that client. But then they go to the client and they tweak it, right, within the conversation and all that kind of stuff. Whereas I think with AI, you can actually guarantee that the AI agent is using that deterministic model, applying all the right compliance policies to make sure that they do the right thing. And as a client, sometimes you wonder, am I being recommended this because it's earning them the highest sales commission or because it's right for me? And with AI, we sort of have this opportunity to actually take the commissions out of the equation altogether. AI doesn't earn commission. And not only that, but it doesn't need to know the fees that an institution actually charges on any particular product, right? That can be baked into the net expected return for the portfolio optimizer and the allocation model to relay to the client. And so as we talk about transparency and performance, I would say it's not a high-frequency trading firm, and so we're really doing, asset allocation, financial planning, et cetera, for the clients. And so milliseconds are not really what matters here. It's really the explainability, the transparency that we can provide to the client.
Awesome. Yeah, great insights from this panel. I think we've spoken a lot about how AI LLMs can really streamline a lot of how we think about finance and some of the processes that are reproducible or streamlined and help us leverage our energy and our focus and attention a little bit better as humans to focus on the areas that really require our thinking and our expertise. So it really helps us scale ourselves as well. To that end, I think it'd be only fair if we took an objective view at generative AI and LLMs. I'm curious to this panel, what do you all think, I guess Sigrid and the rest of the panel, are some of the limitations when we think about applying generative AI and LLMs to finance? And along with some of these limitations, what do you think are some potential solutions that we have here that we can continue to have AI in this loop in finance?
One of the big limitations I see is the alignment of incentive within the organization. As I mentioned, right, AI cannot just operate in its corner, in silo. It has to be fully integrated with all the other functions. And so it's really important that there is a top-down mandate on, yes, we're going to transform our company with AI, but so everyone needs to be on the same page. That also means that those people need to be educated on what AI can and cannot do. Education is the second big thing that we need to watch out for. It means educating. So when I first joined EFG, the first thing I did is start from the top, train the board, the C-suite on what AI can and cannot do. Then the next level is all the different employees, making sure they have a literacy. And the last piece that we shouldn't forget is actually the AI team. The technology that you guys are building is evolving so rapidly that we also need to keep up. When I studied, there was no such thing as LLM or agents, so we definitely need to keep up as well. The third thing I would say is technology. Banks being very risk averse, a lot of us started on premise, and with the agility and the rapidness in which things are changing, I don't think we can afford to continue on premise. Bringing a server, ordering it, setting up the OS, making sure you have the right software, it takes a long time. It takes also a lot of engineering resources, so it depends a little bit on the size of the company, obviously. But so for me, ideally, I want to outsource this as much as possible, and so cloud is the obvious. But it needs a change of mindset needs to happen that, yes, it's okay to have some of the more confidential data moved there with the right controls, so the right encryption and measures in place. So the technology. And the last piece is the governance, as I mentioned. It's always, for us, we see it as a prerequisite to establish the trust with the clients, with the internal stakeholders, that we are bringing in AI in a responsible manner. So it's really a bunch of different dimensions before banks can fully leverage all the technology that is being set up now.
Yeah, that's great. I think there's a lot of kind of optimization required here as well. I think in terms of, as we think about how far AI has come, initially we started out with traditional machine learnings, and then later on we moved into kind of deep learning-esque sort of models, and now we have generative AI, now we have also agentic AI, where we're able to make decisions on the outputs of these LLMs and not just having it spew kind of these lists of citations, resources, and still a human having to be able to kind of babysit and also make determinations. Now an agent is almost able to, or sometimes already able to, end-to-end spearhead these processes and make decisions on top of the information that's being generated. So that represents almost next step of what we're thinking about in terms of kind of what we call autonomously operating AI. I think to that end, I think as AI systems make more decisions autonomously, I'm curious on this panel's kind of thoughts in terms of what audit mechanisms or what sort of stopgaps or guardrails do we have in place to make sure that we're effectively managing risk and bias in these models. I think a lot of times when we think about modeling, a lot of the decision making is based on the training data that we input. And so I'm curious on Charles and Sigrid's as well as Sambit's opinion on what are some of the guardrails or mechanisms in terms of audit we can have in place to make sure that the outputs of AI are representative, are ethical, and are factual when it comes to financial decision making.
Yeah, so as we talked about before, I mean, the risk-based approach to governance, the trust is at the center of wealth and our approach. And so we invest most of our time actually in the guardrails, in designing the processes. There's a human in the loop for any actual trade happening, any money movement happening, et cetera. And of course in the evals, right, to make sure that the LLM is not going off script. We use RAG to make sure it has the right concept. We use function calls to make sure that it's pulling the right expected returns or information about the client's account. But actually, at its core, what we've learned is that it is much easier to make specialized agents in an agentic architecture where different models are specialized for different use cases. And for example, we use traditional deterministic financial models to do things like borrower risk factor decomposition, correlation analyses for asset allocation, for processing long time series of data up to the second as the market moves and things like that. And we primarily use the LLM to orchestrate as well as to communicate these complex financial outputs in clear and intuitive manner to the client. But the UX that we've noticed is also important, right? It's not just a chatbot that's spewing things. It's actually built throughout the wealth journey so that the things that are backed by hard quantitative analysis, the recommendations that are coming from the deterministic models are shown as such. And the LLM outputs and things like that are kind of explained on the side and clearly marked as such as well.
Awesome. Yeah, that's a great thought in terms of insight and how we can use some of these technologies. I think looking forward, maybe within the next 5 years, what do you guys think are going to be the largest kind of financial edge as we think about it in the context of generative AI, LLM? Is it going to be better data, better modeling, something else entirely? What is this panel's perspective on that? And in terms of how quickly AI is changing from day to day, originally we had ChatGPT come out, and now we have almost, let's say, like 3 to 5 models daily that are coming out, each with new different kind of specialties as well as different ways of training and optimization here in terms of kind of expertise. So in terms of the next 3 to 5 years, given how rapidly AI is changing, what does this panel see as where we're going in terms of kind of the biggest area of financial edge and where AI can take its impact in finance to the next step?
So better data, better models, it's obvious is going to be very important. But I think the biggest hurdles for banks is to change their mindset and really, really, truly transform themselves. It can't just be adding a feature in the background. We have to actually redesign entirely how we do banking. And I think what Charles is doing is much more advanced than what we are doing on the more traditional side of things. But it's the ability to change mindset and start looking at processes as a whole and how they can be fully redesigned, which means that the process is going to change. What the people on the process are going to do is going to be different, right? The compliance person probably will be moving from actually doing the process to supervising what the agent is doing. And so the ability to really have that vision of shifting the mindset on how you look at processes, and then the next step is the ability to actually implement those changes and have the technical expertise. But it's really a true revolution that we are living now, and it can't just be adding 1 or 2 features. It has to be the entire company has to be onboarded, and everyone has to pitch in to make sure that we really redefine how we do finance today.
So I just quickly add a few points from technical aspect, and the many aspects that Sigrid said. Data is gold here. So scaling laws, if you have followed recently, scaling laws. So the models actually have trained, they've seen all the data, like all this human-generated data. Now actually, synthetic data generation, right, is a key topic. That's one. The other one I want to point out is that it's the balance between the model built pre-training versus test time computing. So the shift is happening basically while the model is inferring, taking more time to think. It's like mimicking more human process. We have some intelligence, but actually on the fly, we kind of think. So putting in the process like a pre-training, model training versus the test time, the inference time. So that is actually a big play. We are seeing this in recent models. So the 2 things I want to call out.
The reason I'm most excited about LLMs in finance is that the traditional finance and expertise has always been a pyramid. Not a pyramid scheme, just a pyramid. Where at the bottom you have public markets, one size fits all, Googleable advice, and at the very top you've always had this pinnacle that's called the family office, where you have the world's foremost human experts in each vertical, insurance, derivatives, private markets, portfolio construction, all working together to make the financial asset universe work for you, your family, your tax situation, etc. And for the first time, we see with LLMs the ability to potentially imbue that domain expertise in the LLM and put it in everyone's pocket so that everyone's walking around with these world-class experts that deeply understand their context, every conversation that they've had, their family situation, has infinite compute to merge it with the financial asset universe and really deliver that advice personalized at scale at a low cost that's never been as accessible as before.
Great. That brings us to time. I'd like to thank everyone on the panel, Charles, Sambit, and Sigrid for their insights, and also the audience for participating in this journey. Thank you.